Today, property signs for the 15th of June 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today we look at house price trends in Australia and New Zealand. We also consider elder abuse in financial services, US consumer research, and the latest market trends in meme stocks and cryptos. And today's post is brought to you by Ribbon Property Consultants, and Edwin will be on our live show tonight at 8 p.m. Sydney time, and you can ask him a question live. Housing prices in capital cities have grown at the fastest rate in a decade, according to a new report from the Real Estate Institute of Australia. And the weighted average capital city median price for houses increased by 6.8% over the March quarter, while other dwellings rose by 2.7%. The weighted average median house price for the 8 capital cities rose to $873,911, with all cities except Canberra increasing. For the year to March, there has been an 11.1% annual rise. At $1.3 million, Sydney's median house price continues its lead ahead of the other cities, 49.8% above the national average. Perth had the lowest median house price at $500,000, 42.8% lower than the national average. For dwellings other than a house, the weighted average median price increased to $621,303, rising by 2.7% across the quarter. It had increased across Sydney, Melbourne, Perth, Hobart and Darwin, but remained steady in Brisbane and Canberra and fell in Adelaide. For the year to March, the price for other dwellings increased by 3%. The national capital city vacancy rate came at 3.3%, and that rose slightly, primarily thanks to Melbourne's rate of 6.1%. And a recent report from Australian Property Institute and market research firm The Search People also found that 63% of property professionals expect values across Sydney, Melbourne, Brisbane, Adelaide and Perth to continue rising over the next 6 months, despite affordability and sustainability concerns. Over half, actually 55%, of the survey participants said they believe buyers were overcapitalising when it comes to purchasing property, and 57% said Australian property is now unaffordable. Rafe Bearding, chief executive of the Search People, commented that while most respondents believed a continued boom is set for the sector, 59% also said they believed Australia was seeing the makings of a property bubble. A combination of record low interest rates and buyers' uncertainty of investing in other alternatives is fueling high demand. This, coupled with low supply, is driving a fear of missing out for many buyers, Mr. Bearding said. And as a result, properties are being snapped up significantly above the asking price within moments of being listed in some cases. Around half, or 47%, of property professionals also supported the idea of buyers accessing superannuation to buy property. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, and price discovery and price transparency are hard to find. And then there is the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you'll know you'll have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email on info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can receive a 10% discount offer. Now, according to the Real Estate Institute of New Zealand, the New Zealand housing market has continued its recent strong run, with sales volumes in May running at their highest level for the month of May in 3 years, with 7,550 residential properties sold in the month. The Auckland market led the strong sales results, with 2,766 properties sold in May, which is the best result for that month in 5 years and up 3.7% compared to April. Excluding Auckland, 4,784 properties were sold across New Zealand in May, and that's close to the 4,782 sold in April. And in addition, the national median selling price increased from $805,000 New Zealand dollars in April to $820,000 in May, just short of the record $825,000 median price achieved in March. In Auckland, the median price hit a new record of $1,148,000, up from $1,120,000 in April. A new record median prices were set in a number of Auckland districts and also in Tasman and Canterbury. Median prices declined in May compared to April in 6 regions, including Gisborne, Hawke's Bay, Nelson, Marlborough and Otago. While some of the regions are starting to show signs of prices easing, which will be welcome news for locals who are looking to buy, it's hard to know whether this is a direct result of the 23rd of March announcements, of course they're relating to the changing of the tax rules for residential investment properties, or just the usual winter slowdown, REINZ Acting Chief Executive Wendy Alexander said. This is particularly true given the Auckland market is still forging ahead with another record median price seen in May. There are 2 districts in the Auckland region where the median house price is less than $1 million, Franklin and Papakura. The continued magic of ultra-low interest rates, loose lending and government incentives. This will go on until that changes. Now, today is World Elder Abuse Awareness Day. The Australian Banking Association is calling on the support of every Australian to help stamp out elder abuse across the country as they acknowledge the importance of the World Elder Abuse Awareness Day. Banks have seen too many heartbreaking stories of older vulnerable Australians who've been financially exploited by family members or close friends. Anna Bligh, the CEO of the Australian Banking Association, said elder financial abuse is a community problem which will likely increase with an ageing population, so we must all be alert to help bring it under control. By 2055, we expect 1 in 4 Australians to be over 65, so elder financial abuse continues to be a growing problem, as Blythe said. Although, through improvements to training and processes, banks are playing there, the more people are aware of it, the more chance Australians can help reduce the problem. Elder financial abuse can be hard to detect, so we really need Australians to be aware of how people might be taking advantage of their parents, loved ones or friends, so we can all help to stamp this out. Financial abuse can take many forms, including spending money without permission, forging signatures, coercing someone to sign something, pension skimming, using a person's bank card without permission, as well as denying them access to their own money or bank statements. So if you're concerned that you're being coerced or taken advantage of financially, it's important to contact your bank. And banks have introduced a range of policies and procedures to help put a stop to elder financial abuse. These include specialist training for staff to help them recognise warning signs and to support customers, helping customers manage their own finances, for example, co-signatory accounts, preset transaction limits, transaction notification blocks on overseas transactions, and referring customers for internal and external support, for example, specialist customer assistance teams in the bank, financial counselling, seniors' rights, and similar organisations. And then using software and other means to identify suspicious transactions and reporting suspected abuse to relevant authorities. If a customer is concerned they are being financially abused, they should contact their bank directly. Now, over in the US, according to the May 2021 survey of US consumer expectations, median year-ahead inflation expectations increased to 4% in May from 3.4% in April. This marks the measure's 7th consecutive monthly increase and a new series high. The 3-year outlook rose a more modest 0.5 percentage points. Household expectations about home prices and rent changes, earnings, income and spending growth all increased in May, and labour market expectations improved, with unemployment and the probability of losing one's job both reaching series low. The SCE is a nationally representative internet-based survey of a rotating panel of around 1,300 US household heads. Respondents participate in the panel for up to 12 months, with a roughly equal number rotating in and out of the panel each month. Unlike comparable surveys based on repeated cross-sections with a different set of respondents in each wave, this panel allows the surveyors to observe the changes in expectations and behaviours of the same individuals over time. The median expected growth in household income increased by 0.4 percentage points to 2.8% in May, and that's the highest level since January 2020. The increase was driven mostly by respondents with high household incomes, those above $100,000. Median household spending growth expectations rose to a series high of 5% in May from 4.6% in April. And the increase was broad-based but more pronounced among respondents with annual household incomes of more than $100,000. Perceptions of credit access compared to a year ago improved, with more respondents finding it easier to obtain credit now than a year ago. In contrast, expectations about future credit availability deteriorated slightly, with more respondents expecting it will be harder to obtain credit in the year ahead. The average perceived probability of missing a minimum debt payment over the next 3 months declined by 0.3 percentage points to 9.7%, which is below the 12-month trailing average of 10.3%. And the median expectation regarding a year-ahead change in taxes at current income levels increased by 0.3 percentage points to a series high of 4.7%. A median year-ahead expected growth in government debt increased to 16.4% from 14.4% in April. The mean perceived probability that the average interest rate on savings accounts will be higher 12 months from now also increased to 29.3% from 28.7% in April. And perceptions about households' current financial situations compared to a year ago deteriorated slightly in May, with more respondents reporting being financially worse off than they were a year ago. Respondents were also more pessimistic about their households' financial situations in the year ahead, with fewer respondents expecting their financial situation to improve a year from now. The mean perceived probability that US stock prices will be higher 12 months from now decreased by 1.6 percentage points to 40.8%. Now, in markets, shares of movie theatre chain AMC Entertainment Holdings were aloft to start another week, with the company's stock sharply higher amid a social media campaign to push it towards $60 a share. The so-called #AMC Day was the third most popular trend on Twitter on Monday, and presumably helped to give a fresh catalyst to one of the most popular meme stocks this year. Shares of AMC were up 15.38%, having climbed 2,659% so far in 2021, as individual investors on social media sites like Reddit and Discord have come together to help drive up values and hurt investors who are betting heavily on a return to earth for it and other meme stocks, such as GameStop. AMC shares rose 15.4% on Monday to close at $57, just below its June peak of $62.55. And shares of GameStop, another popular meme stock, fell 1.7%, but they've still gained 1,107% thus far this year. By comparison, the Dow Jones Industrial Average was down 0.25%, having rallied more than 12% this year, while the S&P 500 index has just gained 13.3%, and the Nasdaq Composite Index has gained just 10%. The performance of so-called meme stocks have helped AMC to build a market capitalization approaching $30 billion, though many analysts feel the company will struggle to match its valuation in terms of earnings or indeed revenues. And Hash AMC Day appears to be a trend that was launched a month ago, but was gaining traction on Monday, perhaps as The Quiet Place became the first movie to surpass $100 million at the US box office in the pandemic era, and as bullish individual traders anticipated moviegoing to increase in the lead-up to Marvel franchise tentpole Black Widow, which was set to make its debut in early July, even as it's set to simultaneously go live on Disney Plus Premiere. And banking giant JPMorgan has been sitting on about $500 million worth of cash, waiting to invest in higher rates in the coming months instead of buying treasuries or other securities, Chief Executive Jamie Dimon said on Monday at a virtual banking conference. We do expect rates to stay low for a bit longer. The Fed has told us that, Dimon, the long-term boss of JPMorgan Chase & Co., said on Monday at the Morgan Stanley US Financial Services Conference. But if you look at our balance sheet, we have around $500 million in cash, and we've actually been stockpiling more and more cash, waiting for an investment opportunity to invest in higher rates, Dimon said, according to a transcript of the conference. The plan aims to position the bank to benefit from rising rates, both from the short end and the long run and long rates, he said, adding that it will hinge on the decision we make over the next 6 to 9 months. But I do expect you're going to see higher rates and more inflation today, he said. The yield on the 10-year Treasury note rose about 3.7 basis points on Monday to 1.4999%, well off the 1.749% high for the year that was hit back in March, but it's still up more than 60 basis points on the year, according to the most recent data. The Federal Reserve's rate-setting meeting gathers for 2 days this week, starting on Tuesday, with investors awaiting a policy update on Wednesday to see how the central bank is grappling with evidence of surging inflation in recent months or not, but also slack in the job market during the COVID pandemic recovery. And investors will also be listening to any hint of change in terms of the Fed outlook for rates and around future plans for its monthly asset purchases, which of course is viewed as a first step to tightening of its easy monetary stance. Will they be talking about tapering or not? The US Central Bank is at present buying about $80 billion of treasuries and $40 billion of mortgage-backed securities each month, while keeping benchmark interest rates between 0% and 0.25%. But while inflation has been surprisingly hot, many economists and strategists expect the Fed to wait until the fall to see how the labour market responds to the inflation spike. And finally, the world's #1 crypto and prices of digital assets more broadly headed higher on Monday. At last check, Bitcoin prices had climbed more than 12% and were changing hands at around $40,631, which would mark the highest level since late May. Gains for the crypto are still far from its mid-April peak, which hit $65,000, but bullish investors view the recent price run-ups as constructive and potentially auguring well for Bitcoin values in the longer term. The rally was partly attributed to comments from Tesla's CEO Elon Musk, who appeared to acknowledge that the electric vehicle maker had sold some 10% of its crypto holdings, but also said that the company would resume allowing purchases of its products in Bitcoin if miners of the digital asset can confirm that they use 50% clean energy. Other cryptos also climbed in sympathy, with Ether and Ethereum also rising, as well as the meme asset Dogecoin. Those assets, of course, are still well off their recent peaks back in May. So standing back once again, more news on home prices, which suggest the low interest rates is continuing to drive the markets higher, but not uniformly. Houses more so than units. And of course, the question will be how long that goes on for. Meanwhile, the question of the financial markets and crypto is still extremely volatile. And I guess everybody will be waiting to see what the Fed does over the next couple of days. Don't expect too much, though. This is not going to get solved anytime soon. We're in, I think, for a long, slow haul. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.